Who remembers our fourth planing variable? That's right, Boots. It was character. Let's do that character thing in video T8D, along with Dora and her friends. When we think of character, we often consider individuals we know, or may have heard of, that display leadership that has come to benefit all humankind. Well, 3 out of 4 ain't bad. That's right again, Boots. That's not character when it comes to tax. But we already did talk about different character types in tax. Let's spend some time on the middle one, capital. Backpack reminds us that capital gains and losses generally come from the sale, exchange, or disposition of capital assets. So to determine if we have capital character, we need to know if we have a capital asset. What are capital assets? I'm not sure. Let's ask the map. The map says that the way capital assets are defined is what is not a capital asset. Oh my, Boots, that's a double negative. But sometimes that's how the Internal Revenue Code works. Things like inventory, accounts receivable, and trade or business property, these are all not capital assets. If Tico could talk, he'd tell us that ordinary assets are the flip side of capital assets, and that sales of ordinary property result in ordinary gains and losses. That's right, Boots. Ordinary gains are taxed at ordinary rates. Benny the Bull is here to explain to us how capital gains and losses are treated by different entities. Starting with individuals. Long-term capital gains are taxed at a 0, 15, or 20% rate, depending on the taxpayer's level of income. Individuals can deduct a net capital loss of up to $3,000 against their ordinary income. And any net capital loss that is limited can be carried forward indefinitely. Corporations, on the other hand, do not enjoy preferential rates. They also cannot offset any ordinary income with net capital losses. A corporation can only offset capital gains with capital losses. Similar to net operating losses, corporations can carry net capital losses back for 3 years and forward for 5 years. Thanks, Benny. As it turns out, Swiper is a tax lawyer. Given his proclivity towards swiping, I'm not surprised. But he knows a lot about the tax law and wants to show us how capital gains and losses differ from ordinary ones. He says to start with a corporation. You can see in the first column that a capital loss provides no net benefit to a corporation. Because the corporation cannot offset its ordinary income, it will have to carry the cap loss either back or forward. In the second column, the ordinary loss can offset ordinary income and thus benefits the corporation. In the third column, the capital gain is treated like any other income by the corporation and is taxed at ordinary rates, which means there's no real difference between the third and fourth columns. Individuals, however, are treated differently. The capital loss can be used to offset ordinary income, but only as much as $3,000. The remaining $1,000 of loss will be carried forward. The ordinary loss, similar to the corporation, in column 2 is fully deductible and provides the greatest benefit. In column 3, capital gains are included as income, but the tax, at least for this ordinary rate taxpayer, is only 15% because of the preferential rates. The ordinary gain is also income, but does not enjoy preferential rates and yields a greater tax than a capital gain as a result. Thanks, Swiper. Well, Dora and her friend Boots discovered the secret to capital character in taxes. Now they can focus on why a monkey would wear boots anyway. Thanks for watching.